Centene's shocking Q2 loss. What's behind rising medical costs? The health insurance industry is in turmoil, and Centene's recent financial report is a stark reminder of the challenges it faces. Imagine a scenario where rising medical costs threaten the very foundation of healthcare coverage for millions. That's precisely what's happening. And Centene's second quarter results, as track and see the historical cost to stakeholders or repriority to keep your financial healthcare intact. It's precisely what's happening, and Centene's full-year results are a red flag, signaling a deeper crisis. But here's where it gets even more concerning. Centene, a managed care giant specializing in Medicaid, Affordable Care Act ACA plans, source, and many Affordable Care Act plans fell and minimized contributions, home ownership in the process. Centene, a managed care giant specializing in Medicaid, Affordable Care Act ACA plans, found itself at the epicenter of this financial storm. Earlier this month, the company withdrew its 2025 earnings guidance, source, at live coverage, hashtag stock market today, Dow, SP 500, NASDAQ, 07/01/2025. This Centene shares plunge after pulling guidance, C55Z, CXQ, XARJ, citing skyrocketing Medicaid costs and persistent issues within its ACA business. This move sent shockwaves through the market, as it highlighted the growing instability in an industry already grappling with unprecedented challenges. And this is the part most people miss. The implications of Centene's struggles extend far beyond its balance sheet. They raise critical questions about the sustainability of current healthcare models and the future of affordable coverage for vulnerable populations. Are we witnessing the beginning of a systemic collapse, or is this a temporary setback? And the answer could reshape the healthcare landscape for years to come. Controversially, some argue that the root of the problem lies in the structure of government-funded programs like Medicaid and the ACA, which they claim are inherently flawed and unsustainable. Others counter that the issue is more about mismanagement and lack of innovation within insurance companies. What do you think? Is the current system doomed to fail, or can it be salvaged with reforms and better oversight? Share your thoughts in the comments, and let's spark a conversation that could influence the future of healthcare. Centene's surprise loss, rising medical costs, and future outlook. Shocking loss for Centene as healthcare costs explode. What does this mean for the future of insurance? The healthcare insurance sector has been bracing for impact, but the recent news from Centene sent shockwaves through the industry. The company unexpectedly reported a significant quarterly loss, leaving investors reeling and raising serious questions about the sustainability of government-backed insurance plans in the face of skyrocketing medical costs. Centene stock plummeted nearly 15% in pre-market trading, dragging down competitors like Elevance and Molina Healthcare, who have also sounded the alarm about rising expenses. But here's where it gets controversial. The insurance industry has been under immense pressure for the past couple of years due to a perfect storm of factors driving up medical expenses. On one side, there's a surge in demand for services like behavioral health treatment, home health care, and expensive prescription drugs. On the other, the expiration of pandemic-era subsidies and Medicaid protections has resulted in a shift in enrollment demographics. Essentially, healthier individuals are leaving these plans, leaving a higher concentration of individuals with more complex and costly medical needs. This squeezes insurers' margins and creates a precarious financial situation. And this is the part most people miss. Centene, which primarily focuses on government-sponsored health plans, reported a medical cost ratio, MCR, of 93% for the quarter. For those unfamiliar, the MCR represents the percentage of premiums an insurer spends on actual medical care. A higher MCR indicates a smaller profit margin or even a loss. Wall Street analysts had projected an MCR of 89.3%, making Centene's actual figure a glaring indicator of the financial strain across its various business segments. Morningstar analyst Julie Utterback pointed out the surprisingly high MCR, suggesting that while all major lines of business were affected, the individual exchange business likely bore the brunt of the impact. So what exactly caused this unexpected loss? A significant factor was a downward revision in the anticipated 2025 risk adjustment revenue. This revenue is a crucial part of the Affordable Care Act, ACA, designed to distribute costs fairly among insurers based on the health status of their members. Think of it as a balancing mechanism. However, this adjustment, coupled with escalating Medicaid expenditures, pushed Centene into a second quarter adjusted loss of 16 cents per share. This is a stark contrast to the expected profit of 86 cents per share, according to data from LSEG. Centene CEO Sarah London acknowledged the disappointing results, but emphasized the company's understanding of the underlying issues and their commitment to restoring profitability. Centene plans to address the situation by requesting premium increases for its Obamacare plans for 2026. This move aims to account for the higher than expected proportion of members with significant healthcare needs. The company expects these corrective pricing adjustments to be implemented in states representing the majority of its Obamacare membership. This situation raises some critical questions. Is this a sign of systemic issues within government-sponsored healthcare plans? Are premium increases the only solution? Or are there more innovative approaches to cost management? What impact will these rising costs have on access to affordable healthcare? Do you believe Centene's strategy will be effective in the long run? Share your thoughts and perspectives in the comments below. Let's discuss. Perhaps a more radical approach if needed, like a complete overhaul of the risk adjustment mechanism. What do you think?